counting down the days to RebelCon, and virtual passes are now available at an early bird discount of $200 off the normal ticket price. This virtual pass gets you live access to all general sessions with our expert keynote speakers, as well as links to view the sessions later. This deal will end soon, so get your RebelCon virtual passes now. Hit the QR code for more info or visit rebelcon.marketrebellion.com.
And happy Friday, Market Rebels. Hope everybody's looking forward to a fabulous weekend. And if you've joined us this week, you know that we have made this, or at least I've made it, Synthetics Week. We started talking about synthetics, one of the more important topics in options trading. Now, I know a lot of you who might be new to this are going, what in the world would we ever need this for? You're just going to have to trust me that it's one of those building blocks that will go a long way into helping you with making decisions, understanding strategies, what makes a strategy tick. A lot of it has to do with synthetics, and that's why we teach them. But it could be a complicated topic, or at least in depth. This is going to be our third session. I think we're going to roll into one more next week and possibly two. So that'll just show you that there's a lot to talk about. But yesterday, we talked about a formula that you could use. And on Monday, I showed you where the formula came from, the intuition behind it. But yesterday, I showed you the formula, the stock plus put minus call equals 0, and that will always give you the right answer. The problem is that unless you can do it in your head, which you'll eventually be able to do, but you got to write stuff down, do a little algebra problem. And it's a little slow and confusing and clunky and awkward, and people go, is there an easier way? The answer is yes, and that's what we're going to talk about today. We're going to look at synthetics, an alternative view. And I like to save this for the end because if you start out with this, then people don't bother trying to figure out the intuition behind the formula. So this is just a little bit of a shortcut way. Still give you the right answer, but it's super, super fast. And I find it really interesting. So let's go take a look at how you can look at a risk graph and figure out the synthetic counterpart. First thing to understand is that a synthetic uses the remaining two. Remember, these are the three building blocks that we looked at: stock plus, or stock, put, and call. All of your synthetics are some combination of these three building blocks. And the idea here is that if you pick one to solve for, the answer is going to be the remaining two. So that's an important concept. The one that you're trying to solve for is never going to be part of the answer. All right. So for instance, if you are trying to solve for stock, what is synthetic stock? The answer is not going to include stock. That's what you're trying to solve for. It would make a lot of sense to say, well, synthetic stock is you go out and buy the stock. Stock isn't part of the answer. The answer is going to be some combination of a put and a call. Now, right now, that's not going to show you what the combination is, but I'm just trying to show you it's always the remaining two from these three assets. If instead you were trying to solve for a put, what is a synthetic put, whether a long or short put? The answer is going to be some combination of stock and call. And then finally, if you're trying to solve for a synthetic call, whether long or short, the answer is going to be some combination of stock and put. Now, how do we figure out that combination? And that's where the alternative view comes in. And what I want you to do is to understand that all synthetics have two components. That's what makes them a synthetic. We're taking one of those pieces, let's say stock, and we're going to rebuild it by using calls and puts. So there's two components to all of your synthetics. There is a stock component, that's what's giving it the delta, and there is an option component, and that's what creates the bend in our risk graph. So let's take a look at the stock component. If you buy shares of stock, this is your risk graph, right? We just have this 45-degree angle sloping upward to the right. So I want you to think of this as leaning to the right or maybe in the northeast direction, going from the lower left part of the screen to the upper right. Now, if you had 200 shares of stock, it would be a little steeper, but it would still be in that same kind of an angle. And these are positive deltas. And the reason that they're positive deltas is that if you own shares of stock, if the stock price rises, you make money, right? The stock moves up here to the right. We have to find out our profit by tracing a line up to this black curve. And if the stock price falls, look what happens. We move left, and to get to that black curve, we have to move down. In this case, we would be down $15 per share. But what makes it positive deltas is that notice that green is matched with green, or in other words, stock price moving up equates to profits moving up, and stock price moving down equates to profits moving down. It's in a kind of a mirror image. Up is matched with up, down is matched with down. That's going to be positive deltas or long shares of stock. Now, if we look at short shares of stock, they are going to be leaning left. All right, they're going to be leaning from the, let's say, from the bottom right into the upper left. So that's going to be more into the northwest corner. Again, moving from the bottom right in this direction. That's what a short stock position looks like. And the reason that it's called a short stock position or negative deltas is that if the stock price rises, we actually lose money. And if the stock price falls, we actually make money. So notice now that red is matched with green over on the right side, green is matched with red, they're opposite. That's why it is negative delta. It moves inversely. Profits come from the stock price falling and losses arise from the stock price rising. Those are negative deltas or a short stock position. So as you're going to find out, that's super easy to identify visually when we look at some examples. What's the second thing you have to consider? What about the option component? So we just looked at where the stock component comes from. We're going to identify it from the angled part of our risk graph. But what about the option? It's just a bend. It's a flat line. How would you determine that? Well, this is actually just as easy, if not easier. And what you have to understand is you are simply going to switch your calls for puts or your puts for calls. You've heard us many times say that calls are puts, puts are calls. Just depends on how we delta hedge them. And this is why. So for example, let's say that you're trying to figure out a synthetic long call. You know that part of the answer is going to be a long put. Notice that the sign is the same. Long is matched with long. So again, if you're trying to solve for a long call, don't say, well, it's got to be a call. And nope, call is not part of the answer. Short option is not part of the answer. If you're trying to solve for a long call, you can immediately say long put plus some kind of delta. What if you're trying to solve for a long put? Just the opposite. It's got to be a long call plus some kind of delta. What about for a short call? Right off the tip of your tongue, it's got to be a short put in something, just the opposite. Short call, short put. And finally, if you're trying to solve for a short put, you know instantly that it's short call plus some deltas. It's just a question of how we delta hedge them. That's what's making it a synthetic. So let's take a look at some examples. Here is the risk graph for a long call. It's a $50 call. There's our bend right there at 50. That's the option that's creating the bend. So somebody walks up to you and says, what is a synthetic long call? Well, what do you know? We know it's got to be long put plus something, right? We're just going to switch out the long call for the long put. But we have to figure out the deltas. What are your deltas up here? Notice that this blue line, that is not coming from the option. The angled part of the line is coming from your deltas, from your stock portion. And so it's leaning up this way to the right, so that's long stock. So there's your answer. It's long put and long stock. Okay, so you can just instantly look at that and tell. Let's try another one. What's a long put? Here's your risk graph, or as you get a little better, you'll be able to visualize it. And so what is a synthetic long put? Well, right off the tip of your tongue, you know right immediately that it's a long call plus something. We're just going to switch out the long put for a long call. What about the deltas? What does this look like when it's leaning out this way to the left? Looks like short stock, right? Well, it is. That's where that angled part of the line is coming from. It is not coming from an option. So it must be long call plus short stock. See how it's super fast once you learn this little trick. So let's try to speed them up now. Let's take a look at this. This is a short call. What is that synthetically? I know it's got to be short put. Just going to switch those out. What kind of deltas are these? What do y'all think? Short stock. So it's short put, short stock is the same thing as a short call. This is sometimes called a sell right, kind of the opposite of a buy right or a covered call. You would be shorting shares and selling a put as your hedge. What about a short put? This is our risk graph for a short put. What does it equal synthetically? Instantly, what do you know? What's the first piece of the puzzle? Short call plus something. What are your deltas over here? Well, it looks like it's leaning up to the right. That must be long stock. So short put is short call and long stock. All right, so it's just that easy. Now, the final thing that you might run into is what about synthetic long stock? Short stock's just going to be the opposite, but let's just do the long stock. What does long stock have for deltas? Positive deltas. That's what we just talked about. Well, we know that a synthetic long stock position has to have positive deltas. We also know that the synthetic position can't include stock in the answer, so we know it's got to be some combination of call and put. So just think, what combination of call and put could give me positive deltas? Well, I know it's got to be a long call and also a short put. So there is my long call, there's my short put, there's the long call graph in green, there is your short put in red, and there's the resulting risk graph. So what would be a short stock position? Be short call, long put. Just the opposite. So that's another thing to understand, is that there are 6 basic synthetics, but I really like to think of it as if there's only 3. So if you want to figure out a long call, stock plus put, long stock is call minus put, and long put is short stock, long call. If you can get those 3, just flip them, put a minus sign, watch what happens. We go to this side. What are the second 3? Well, it would be a short call position. Over on the left, we have positive S and positive P. Look over on the right, negative S and negative P. Over on the left, we have a positive stock is call minus put. Short stock must be put minus call. Positive P, negative C. Over on the left, we have a positive P is short stock long call. What's a minus P or a short put? Plus S minus C, or long stock and short call. So it's really just that easy. So what I would encourage all of you to do, work with this. You don't need to knock yourself out with it and practice 8 hours a day. Just do it once or twice in the morning, once or twice in the evening, and trust me, this will become absolutely second nature to you. And so it will go a long way into our future discussions and topics on options, and I'm going to point them out where the synthetics are in future classes. Now, I do have a question for the group, a little thought question for the weekend. Some of you may have thought and kind of figured out, hey, wait a minute, something is not quite right here. If I have a synthetic long call over on the left, and I know, or I'm sorry, a long call on the left, and I know it's synthetically equal to stock plus put on the right, risk graphs are equal, something's not right here. Because if we go into a pricing model, we might see that we have to pay $5 for this call. So I could pay $5 or $500 and get that risk graph. Over on the right, what do I have to pay? I've got to pay $100 for the stock and maybe $5 for the put. Okay, and the point is I have to buy the stock and the put. Well, that's $105. So how can we say that they're synthetically equal if they don't cost the same and yet they produce the same risk graph? So that's kind of a good question. There's a very good answer for it. And I want you to think about it this weekend while you're practicing, and we'll talk about it on Monday. And so with that, I want to wish everybody a fabulous weekend. We hope to see you on Cocktail Hour at 5 p.m. Eastern Time. And if not, please join us Monday, Thursday, Friday next week for more trading tune-ups. Have a great weekend, everyone, and we'll see you then.